Today, we're diving into the world of Chinese ETFs, but not just any ETF. We're talking about the YINN, the wild, the 3x leveraged beast. They say China's growth is explosive, but the YINN ETF takes it to a whole new level. It promises 3x the daily return of a major Chinese stock index. Sounds amazing, right? Well, hold on to your hats. Because with great potential comes great risk. Before you jump in, there's a lot to unpack. Fees, leverage, even noodles, you'll see. So, hit that subscribe button and get ready to learn everything you need to know about the YINN ETF, the good, the bad, and the potentially ramen-inducing. What is the underlying index for the YINN ETF? The underlying index for the YINN ETF is the FTSE China 50 index. This index tracks the performance of the 50 largest and most liquid Chinese companies listed on the Hong Kong Stock Exchange, HKEX. Here's a deeper dive into what that means for YINN. Focus on large-cap companies. By tracking the FTSE China 50, YINN concentrates on established and well-capitalized companies in China. These companies are generally considered to be less volatile than smaller companies. Market capitalization weighting. The FTSE China 50 uses market capitalization weighting. This means that the companies with the largest total market value, stock price multiplied by outstanding shares, have the biggest influence on the index's performance. So, the performance of giants like Alibaba or Tencent will have a more significant impact on YINN compared to smaller companies in the index. Liquidity focus. The index constituents are chosen based on their liquidity, meaning they are actively traded on the HKEX. This ensures that YINN can efficiently buy and sell the underlying holdings to track the index's performance. Hong Kong listing. It's important to note that the FTSE China 50 focuses on companies listed in Hong Kong. This excludes A-shares, which are shares of mainland China companies traded on stock exchanges within China. A-shares can be more challenging for foreign investors to access due to regulations. What is the expense ratio of the YINN ETF? The expense ratio of the YINN ETF is advertised as 1.47%, but there's more to unpack here for a professional investor. Let's delve deeper into the structure of the expense ratio. Gross versus net expense ratio. YINN reports both a gross expense ratio, 1.48%, and a net expense ratio, 1.47%. The difference is minimal, but it's important to understand. The gross expense ratio reflects the total annual costs incurred by the ETF, while the net expense ratio takes into account any expense waivers or reimbursements from the fund manager. Expense breakdown. The 1.47% expense ratio encompasses various fees, including management fees. These fees compensate the fund manager for their services in overseeing the ETF's investment strategy and operations. Administrative expenses. These cover the costs associated with running the ETF, such as legal fees, accounting fees, and custodian fees. Other operating expenses. This category might include marketing expenses, audit fees, and technology costs. Expense waivers. Direxhen, the issuer of YINN, has implemented an operating expense limitation agreement. This agreement states that Direxhen will waive a portion of its management fee or reimburse the ETF for other expenses until September 1, 2025. This effectively reduces the net expense ratio to 0.95% for that period. However, this waiver is not guaranteed to be extended beyond the expiry date. What is the YINN ETF's investment objective? The YINN ETF's investment objective is to achieve daily returns that are 300% of the daily performance of the FTSE China 50 index, before fees and expenses. Here's a breakdown of what this entails. Leveraged exposure. YINN is a leveraged ETF, meaning it uses financial instruments to magnify the returns, both positive and negative, of the underlying index. In this case, it aims to deliver 3 times the daily return of the FTSE China 50. Focus on daily performance, the emphasis is on daily returns. This means YINN attempts to replicate the performance each trading day, not over longer periods. Due to the compounding effect, holding YINN for extended periods might not result in exactly 300% of the FTSE China 50's return. Before fees and expenses, it's crucial to remember that the 300% return target is before the expense ratio and other fees are deducted. These costs can erode returns over time. Key considerations for professional investors. Potential for amplified gains. If the FTSE China 50 rises by 1% in a day, YINN would theoretically gain 3%. This can be attractive for investors seeking magnified growth potential in the Chinese market. Amplified losses. The flip side is that losses are also amplified. A 1% decline in the FTSE China 50 would translate to a 3% loss for YINN. This significantly increases volatility and risk. Not suitable for long-term holds. Due to compounding effects, holding YINN for extended periods might not deliver a precise 300% of the underlying index's return. This makes YINN less suitable for long-term buy-and-hold strategies. Does the YINN ETF follow a replication or sampling strategy? The specific replication strategy used by YINN ETF isn't publicly disclosed by Direxin, the issuer of the fund. However, based on the characteristics of YINN and leveraged ETFs in general, we can make some educated guesses. Leveraged ETFs and replication challenges. Traditional full replication, where the ETF holds all the underlying assets of the index in proportion to their weighting, becomes impractical for leveraged ETFs. Imagine needing to buy 3 times the amount of every stock in the FTSE China 50 for YINN. This can be immensely expensive due to margin requirements and magnified tracking errors. Possible replication strategies for YINN. Optimized sampling. This is a more likely scenario. YINN might employ a sophisticated sampling strategy to select a subset of the FTSE China 50 constituents that best capture the index's overall performance. Financial models and algorithms would be used to choose these representative securities, aiming to deliver returns close to 300% of the FTSE China 50 with a minimized tracking error. Swap-based replication. In theory, YINN could utilize swaps to achieve leverage. The ETF might enter into a swap agreement with a counterparty, where YINN agrees to pay a base rate and receive a return of 3 times the FTSE China 50's performance. However, swap-based replication can be complex and introduce counterparty risk, the risk of the swap counterparty defaulting on their obligations. Difficulties in determining the exact strategy. Because Direxin doesn't publicly disclose the specific replication method, it's impossible to say for certain which strategy YINN employs. What is the weighting methodology of the YINN ETF? The weighting methodology of the YINN ETF isn't directly applicable because it's a leveraged ETF that doesn't hold the underlying assets in proportion to the FTSE China 50 index. However, understanding the weighting methodology of the FTSE China 50 can be helpful. FTSE China 50 weighting. The FTSE China 50 index uses market capitalization weighting. This means the weighting of each constituent company in the index reflects its total market value, stock price multiplied by outstanding shares. Companies with a larger market capitalization will have a greater influence on the index's performance compared to smaller companies. Impact on YINN. While YINN doesn't directly replicate the weighting of the FTSE China 50, the underlying index's composition and weighting will still influence its performance. The leveraged nature of YINN amplifies the impact of the largest companies in the FTSE China 50 because their performance is multiplied to a greater degree. Additional considerations for professional investors. Limited control over weighting. Unlike traditional ETFs that directly hold the underlying assets, investors in YINN have no control over the specific weighting of companies within the ETF. Potential concentration risk. Because YINN amplifies the performance of the FTSE China 50, it also amplifies the concentration risk associated with the index. If a few large companies in the FTSE China 50 experience significant price movements, it will have a magnified effect on YINN's performance. Does the YINN ETF hedge its currency exposure? No, the YINN ETF, Direxin Daily 3x China 50 Index ETF, does not hedge its currency exposure. Here's a breakdown of why. Unhedged structure. By design, YINN aims to deliver 300% of the daily performance of the FTSE China 50 Index before fees and expenses. This daily performance includes any changes in the value of the underlying Chinese stocks due to fluctuations between the Chinese yuan, CNY, and the USD, assuming YINN is denominated in USD. Focus on equity performance. YINN is primarily concerned with magnifying the equity price movements of the companies in the FTSE China 50. Currency fluctuations add another layer of complexity and potentially reduce the efficiency of achieving the targeted leverage of 300% daily return. Impact of unhedged currency exposure. Amplified currency movements. The unhedged structure means that any appreciation or depreciation of the CNY relative to the USD will be magnified by the 3x leverage factor. CNY appreciation strengthens YINN's returns if the Chinese stock market performs positively. CNY depreciation weakens YINN's returns even if the Chinese stock market performs well. Increased volatility. The unhedged currency exposure adds another layer of volatility to YINN's performance, making it even more sensitive to market fluctuations. Why don't leveraged ETFs like YINN typically hedge currency? Cost and complexity. Hedging currency exposure using financial instruments like forward contracts or currency options can introduce additional costs and complexities for leveraged ETFs. These costs could eat into the targeted leverage ratio. Focus on daily performance. Leveraged ETFs like YINN target daily returns. Hedging strategies might introduce tracking errors, difference between the ETF's performance and its target return, if they aren't perfectly aligned with the daily movements of the underlying index. What is the YINN ETF's exposure to large cap, mid cap, and small cap stocks? The YINN ETF's exposure to large cap, mid cap, and small cap stocks is primarily focused on large cap companies, with minimal to no exposure to mid cap and small cap stocks. Here's why. Underlying index focus. YINN tracks the FTSE China 50 Index, which exclusively consists of the 50 largest and most liquid Chinese companies listed on the Hong Kong Stock Exchange, HKEX. Market capitalization weighting. The FTSE China 50 weights its constituents based on their market capitalization. By definition, the largest and most valuable companies receive the highest weightings. Limited to no mid-cap and small-cap exposure. Due to the index selection and weighting methodology, YINN has minimal to no exposure to mid-cap and small-cap stocks in the Chinese market. Understanding the implications. Large-cap stocks are generally considered to be less volatile than mid-cap and small-cap stocks. This can be beneficial for investors seeking a more stable exposure to the Chinese market. However, focusing solely on large caps might limit the potential for higher growth that can be associated with mid-cap and small-cap companies. Additional considerations. The definition of market capitalization categories, large cap, mid cap, small cap, can vary depending on the classification system used. However, the core principle remains the same. YINN offers concentrated exposure to the biggest and most established companies in China. The investable universe for YINN is limited to companies listed on the HKEX. This excludes A-shares, which are shares of mainland China companies traded on stock exchanges within China. Investors seeking broader exposure to the Chinese market, including A-shares, would need to explore alternative options. What is the YINN ETF's exposure to A-shares, B-shares, and other share classes? The YINN ETF, YINN Daily 3X China 50 Index ETF, has no direct exposure to A-shares, B-shares, or other share classes. Here's a breakdown of why. Underlying index focus. YINN tracks the FTSE China 50 Index, which exclusively consists of companies listed on the Hong Kong Stock Exchange, HKEX. These companies typically issue H-shares, which are the Hong Kong-traded equivalents of mainland China companies. Limited foreign investment in A-shares. Foreign investors generally face restrictions on directly investing in A-shares, which are shares of companies listed on stock exchanges within mainland China. While there are programs like Stock Connect that allow some limited access, YINN doesn't utilize them. B-shares and other share classes. B-shares are another type of share class issued by some Chinese companies listed in Hong Kong. They are denominated in a foreign currency, typically USD, and have different voting rights compared to H-shares. YINN also likely doesn't hold B-shares or other share classes due to the focus on the FTSE China 50 composition. Key takeaways for professional investors. YINN provides exposure to Chinese companies solely through H-shares listed on the HKEX. Investors seeking exposure to A-shares or other share classes would need to consider alternative investment options like A-share-focused ETFs, if available and accessible. Actively managed funds that specifically target A-shares or other share classes in China. Understanding the implications. Investing in H-shares can offer some advantages, such as potentially greater liquidity and transparency compared to A-shares. However, they might not perfectly reflect the performance of the broader Chinese market that includes A-shares. Investors should be aware of the limitations of YINN's exposure and consider their overall China investment strategy. What are the primary risks associated with investing in the YINN ETF? Investing in the YINN ETF, YINN Daily 3X China 50 Index ETF, comes with several inherent risks that professional investors should carefully consider before incorporating it into their portfolios. Here's a breakdown of the key risks. Leveraged structure risks. Amplified volatility. YINN aims to deliver 300% of the daily return of the FTSE China 50 Index. This leverage factor magnifies both gains and losses. Even small movements in the underlying index can translate into significant swings in YINN's price. Tracking error. Due to the complexities of replicating the leveraged performance, YINN might not perfectly achieve its target return of 300% daily. Tracking errors can erode returns over time. Erosion of gains over time. Because of compounding effects, holding YINN for extended periods might not result in exactly 300% of the FTSE China 50's return. This can be especially true in volatile markets. China market risks. Political and economic uncertainty. China's political system and economic policies can be unpredictable, leading to potential market disruptions and volatility that could impact YINN's performance. Currency fluctuations. YINN doesn't hedge its currency exposure. Fluctuations between the Chinese yuan, CNY, and the USD, assuming YINN is denominated in USD, can significantly impact returns. Regulatory risk. Regulatory changes in China's financial markets could affect the companies YINN holds or the way it operates, potentially leading to losses. Other investment risks. Liquidity risk. While YINN typically trades with good liquidity, there's a chance that its holdings or the ETF itself might become less liquid during market downturns, making it difficult to buy or sell shares at a fair price. Expense ratio. The expense ratio of YINN eats into returns over time. While it might seem relatively low, the magnified effects due to leverage can make the cost burden more significant. Counterparty risk. For swap-based replication, if YINN utilizes swap-based replication, less likely but a possibility, the counterparty to the swap could default on their obligations, leading to potential losses for the ETF. What is the bid-ask spread of the YINN ETF? The bid-ask spread of the YINN ETF can fluctuate throughout the trading day. Here's a breakdown of what it means and how to find the current spread. Definition: the bid-ask spread is the difference between the highest price, ask price, that a buyer is willing to pay for a share of YINN and the lowest price, bid price, that a seller is willing to accept. Impact on investors. When you buy YINN, you'll typically pay closer to the ask price, and when you sell, you'll receive a price closer to the bid price. This spread represents the transaction cost associated with buying or selling the ETF. Finding the current bid-ask spread. There are a few ways to find the current bid-ask spread for YINN. Financial websites and apps. Many financial websites and mobile apps provide real-time quotes for ETFs, including the bid-ask spread. Examples include Yahoo Finance, Google Finance, Bloomberg, and CNBC. Trading platforms. If you have a brokerage account, your online trading platform will likely display the bid-ask spread for YINN when you look up the ETF's quote. Factors affecting bid-ask spread. Liquidity. Generally, the more liquid an ETF is, higher trading volume, the tighter the bid-ask spread will be. This is because there are more buyers and sellers actively participating in the market, leading to narrower price gaps. Market volatility. During periods of high market volatility, the bid-ask spread for YINN can widen. This is because investors might be less willing to commit to specific buy or sell prices, leading to a larger gap between the bid and ask. How liquid is the underlying market for the YINN ETF's holdings? The liquidity of the underlying market for the YINN ETF's holdings generally falls within the range of large-cap stocks traded on the Hong Kong Stock Exchange, HKEX. Here's a breakdown of the factors influencing liquidity. Underlying index composition. YINN tracks the FTSE China 50 index, which consists of the 50 largest and most liquid Chinese companies listed on the HKEX. These companies typically have high trading volumes and a large pool of investors interested in their shares. HKEX liquidity. The HKEX is a well-established and liquid stock exchange. This translates to generally good liquidity for the underlying holdings of YINN. Impact on YINN's liquidity. Due to the focus on large-cap companies and the KEX's liquidity, YINN itself is also considered a liquid ETF. It typically has high daily trading volumes, making it easy for investors to buy and sell shares at prevailing market prices. Nuances to consider. While the overall liquidity is good, there can be variations among the 50 holdings in the FTSE China 50 index. Some companies might trade with slightly lower volumes compared to others. Market conditions can also impact liquidity. During periods of high volatility or broader market downturns, even large-cap stocks might experience lower trading volumes, potentially affecting YINN's liquidity. What is the frequency of the dividend distributions for the YINN ETF? The frequency of dividend distributions for the YINN ETF, Direxin Daily 3x China 50 Index ETF, is not fixed and can vary, but it typically occurs quarterly. Here's a deeper explanation. Underlying index distributions. The FTSE China 50 Index, which YINN tracks, consists of companies that may pay dividends quarterly. However, the specific companies and the amount of their dividends can fluctuate. Leveraged impact on YINN's distributions. Because YINN targets 300% of the daily total return, price change plus dividends, of the FTSE China 50 index, any dividends from the underlying holdings are also magnified by the leverage factor. Potential quarterly distributions by YINN. To reflect the dividends received from its holdings, YINN might distribute them to shareholders on a quarterly basis. However, it's important to understand that these aren't guaranteed payouts. They depend on the dividend payments of the underlying companies in the index during that period. The exact timing and amount of YINN's distributions can vary each quarter. How has the YINN ETF performed compared to other China-focused ETFs or investment products? Comparing YINN, YINN Daily 3x China 50 Bull 3x shares, to other China-focused ETFs or investment products requires considering several factors due to YINN's leveraged nature. Here's a breakdown to help you evaluate performance. Focus on total return. YINN targets 300% of the daily total return, price change plus dividends, of the FTSE China 50 index. This means it amplifies both gains and losses compared to non-leveraged ETFs or investment products tracking the same index. Performance comparison. Against non-leveraged China ETFs, over a specific period, YINN's performance could significantly outperform a non-leveraged China ETF tracking the FTSE China 50 index if the Chinese market experiences strong positive returns. Conversely, YINN would underperform during periods of negative returns in the Chinese market, and the losses would be magnified by the 3x leverage factor. Against actively managed funds, comparing YINN to actively managed China funds can be complex. Actively managed funds can outperform or underperform the market depending on the skill of the fund manager. However, YINN's leveraged structure adds another layer of risk and volatility that actively managed funds might not have. Factors to consider when comparing. Investment timeframe. YINN's leveraged structure is designed for short-term bets on the Chinese market. Due to compounding effects, holding YINN for extended periods might not deliver exactly 3x the return of a non-leveraged ETF, especially in volatile markets. Risk tolerance. YINN is a high-risk, high-reward investment due to its leverage. Investors with a lower risk tolerance might be better suited for non-leveraged China ETFs or actively managed funds with a more moderate risk profile. Investment objectives. Are you seeking short-term capital appreciation or long-term exposure to the Chinese market? YINN is better suited for short-term bets, while non-leveraged ETFs or actively managed funds can be used for longer-term investment goals. How has the YINN ETF performed compared to other China-focused ETFs or investment products? Here's a deeper dive into how the YINN ETF, YINN Daily 3x China 50 Bull 3x shares, performs compared to other China-focused ETFs or investment products, building on the previous explanation. Performance drivers for YINN. Leverage effect. The core driver of YINN's performance is its 3x leverage to the daily total return, price change plus dividends, of the FTSE China 50 index. This magnifies both gains and losses experienced by the underlying index. Performance scenarios versus other products. Bullish market. If the Chinese stock market experiences a strong positive trend, YINN will likely outperform non-leveraged China ETFs tracking the FTSE China 50 index. The 3x leverage amplifies the gains. Bearish market. Conversely, during periods of negative returns in the Chinese market, YINN will underperform non-leveraged alternatives. The leverage will magnify the losses, leading to steeper declines in YINN's price compared to the underlying index. Flat market. In sideways markets with minimal price movement, YINN's performance might not be significantly different from a non-leveraged China 50 ETF due to the dampening effect of compounding over time. However, there could still be minor discrepancies due to expense ratios and fees. Comparison with different investment products. Non-leveraged China ETFs. These offer direct exposure to the FTSE China 50 index or similar China-focused indexes without leverage. Their performance will be more muted compared to YINN, with smaller gains during bull markets and smaller losses during bear markets. Actively managed China funds. These funds are overseen by portfolio managers who actively select and trade Chinese stocks. Their performance can vary depending on the manager's skill and investment strategy. They might outperform or underperform the market, but they typically have a lower risk profile than YINN due to the absence of leverage. Additional considerations. Expense ratios. YINN's expense ratio, which covers its operational costs, can eat into returns over time. This cost should be factored in when comparing performance to other investment options. Tax implications. The tax treatment of returns from YINN might differ from non-leveraged ETFs or actively managed funds. Consult with a tax advisor to understand the potential tax implications. How does the YINN ETF's expense ratio compare to similar ETFs? The expense ratio of the YINN ETF, Direxin Daily 3x China 50 Bull 3x shares, can be compared to similar ETFs in two categories. 1. Leveraged China ETFs. These offer leveraged exposure to a China-focused index, similar to YINN's 3x leverage on the FTSE China 50 index. 2. Non-leveraged China ETFs. These track a China-focused index without leverage, providing broader market exposure. Here's a breakdown of how YINN's expense ratio might compare. Leveraged China ETFs. Generally higher, due to the complexity of managing leveraged structures and potentially higher fees associated with derivative instruments used for achieving leverage. Leveraged China ETFs typically have higher expense ratios compared to non-leveraged alternatives. Variations within leveraged options. Expense ratios can vary slightly between different leveraged China ETFs depending on the specific index they track, the complexity of their replication strategy, optimized sampling versus swap-based, and the fund issuer's overall expense structure. Non-leveraged China ETFs. Generally lower, non-leveraged China ETFs typically have lower expense ratios compared to YINN. This is because they don't involve the complexities of managing leverage and might have simpler replication strategies involving directly holding the underlying securities in the index. What are the alternative investment options available for gaining exposure to the Chinese market? Here's a breakdown of alternative investment options for gaining exposure to the Chinese market, considering different risk profiles and investment goals. Broad market exposure, lower risk. Non-leveraged China ETFs. These ETFs track major Chinese stock market indexes like the FTSE China 50 or CSI 300, offering diversified exposure without leverage. Examples include iShares China Large Cap ETF, FXI. SPDR SP China A-Shares ETF, GXC, focuses on A-shares. Sector-specific exposure, moderate risk. China sector ETFs. These ETFs focus on specific sectors within the Chinese market, such as technology, healthcare, or consumer staples. This allows for targeted exposure based on your investment thesis. Examples include CraneShares CSI China Internet ETF, KWEB. Fidelity China Consumer Staples ETF, FXSG. Actively managed China funds, moderate risk. These funds are overseen by portfolio managers who actively select and trade Chinese stocks. They can offer potentially higher returns than passively managed ETFs, but come with higher fees and potentially higher risk due to active management strategies. High growth potential, higher risk. China A shares. These are shares of companies listed on mainland China stock exchanges. They can offer higher growth potential, but are less accessible to foreign investors and might have higher volatility. Consider A-share-focused ETFs, if available, or consult with a financial advisor regarding direct investment options. Other alternatives, varying risk. China ADRs, American Depositary Receipts. These are tradable U.S. securities representing shares of Chinese companies listed on U.S. exchanges. They can offer a convenient way to invest in some Chinese companies, but might not represent the broader Chinese market. China Venture Capital/Private Equity, very high risk. Investing directly in Chinese startups or private companies can offer high growth potential but comes with significant risks, illiquidity, and requires a long-term investment horizon. Choosing the right option. Consider your risk tolerance, investment goals, and time horizon. Broad market ETFs are suitable for those seeking diversified exposure with lower risk. Sector-specific ETFs or actively managed funds cater to investors with a specific investment thesis or who prefer active management. A-shares, China ADRs, or venture capital require a higher risk tolerance and a long-term perspective. When would it be more appropriate to invest in the YINN ETF versus other China investment options? Here's a breakdown of scenarios where the YINN ETF, Direxin Daily 3x China 50 Bull 3x shares, might be a more appropriate choice compared to other China investment options. Short-term bullish bets on the Chinese market. Strong conviction in upward trend. If you have a strong conviction that the Chinese stock market will experience a significant upward trend in the short term, days to weeks, YINN's 3x leverage can magnify potential gains. However, be aware that leverage also amplifies losses if the market goes down. Hedging existing China exposure. Short-term hedge. If you have a long-term investment in the Chinese market through other options, e.g., non-leveraged ETFs, and are concerned about a short-term downturn, a small allocation to YINN, used strategically, could potentially hedge some downside risk. However, this strategy requires close monitoring and carries its own risks. Speculative trading. Experienced investors only. YINN is a volatile instrument suitable for experienced investors comfortable with leverage and its inherent risks. It's not appropriate for buy-and-hold strategies or investors with a low-risk tolerance. Scenarios where other China investment options might be more appropriate. Long-term investment horizon. For long-term exposure to the Chinese market, consider non-leveraged China ETFs or actively managed funds. These offer broader diversification and potentially lower volatility compared to YINN, which is better suited for short-term bets. Lower risk tolerance. If you have a lower risk tolerance and are uncomfortable with the potential for significant losses, YINN is not a suitable investment. Opt for non-leveraged China ETFs or broaden your portfolio with other asset classes to achieve your investment goals. Targeting specific sectors. If you have a specific thesis about a particular sector within the Chinese market, sector-specific China ETFs might be a better choice than YINN, which offers broad exposure to the FTSE China 50 index. Alright everyone, that brings us to the end of our deep dive into the YINN ETF. We explored the mechanics of the YINN, how its 3x leverage works, and how it can magnify both gains and losses in the Chinese market. We discussed the expense ratio and compared it to other China ETFs, highlighting the trade-off between leverage and cost. We presented alternative investment options for gaining exposure to China, considering different risk profiles and investment goals. Finally, we analyzed scenarios where the YINN ETF might be suitable and situations where other options might be a better fit. Before you rush out and buy YINN, remember, it's a high-risk, high-reward investment. Make sure it aligns with your overall investment strategy and risk tolerance. For those who want to learn more, I've included links in the description to articles and resources that compare YINN to other China ETFs and delve deeper into the Chinese market itself. And hey, if you do decide to invest in YINN, just make sure you have enough instant ramen on hand for those potentially volatile days. But hopefully, with the knowledge you gained today, you'll be well on your way to navigating the exciting world of Chinese investments.